Hello, everyone. Today on the Final Bar, we do our normal Friday routine. We wrap the week looking at how the markets have evolved from last Friday to this Friday. If 2 weeks ago was all about accumulation and market upside making new highs, I would argue this week has been more about digestion. You've had the big meal last week. This week was about digesting those gains. Having said that, Strength Friday certainly making stocks finish the week in a position of strength with the S&P making a new all-time high. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we review these markets together using charts, using the information embedded in price, confirmed or validated by breadth, sentiment, momentum, and other measures to try to make sense of things in very uncertain times. This week, as I mentioned in the introduction, all about earnings for the most part. And while I was looking at, as always, lots of different charts, I found myself more than usual looking at individual stock charts, particularly stocks reporting earnings. And there's been a lot of really interesting yin and yang sort of give and takes within sectors. So in semiconductors, you have Intel versus NVIDIA with two very different paths this week. With streaming content, you have AT&T doing one thing and Netflix doing the other, based on subscriber numbers. So a lot of interesting charts to compare and contrast as we make sense and things. Great guest this week on our show, as always. Really enjoyed Sam Stovall's discussion yesterday about the sell in May and go away concept. That was kind of fun. We have other great guests coming up with you soon. On Tuesday, April 27th of next week, we have Todd Sohn from Strategas. On Wednesday, April 28th, we have Joe Duarte from Joe Duarte InTheMoneyOptions.com. The week after, some guests we have coming up, in particular, Jeff Weiss, who is one of my early mentors. I'm very excited to have him join the show next Tuesday, the 4th as well, or 2 Tuesdays out. Also, just to let you know, coming up Tuesday, May 4th, I'll be doing a special event through my firm called Market Misbehavior called Sell in May, 5 charts you need to review. I had a lot of fun with Sam Stovall earlier this week, as I mentioned, going through his content, focused on the sell in May phenomenon. What I'm going to do is talk through 5 charts that I think tell the story of where we're at right now as we lead into this seasonally weaker part of the year, which is sort of May through October. So if you're interested in that, it's free. I'd love to have you join me. It's marketmisbehavior.com/sell-in-May. I'd love to have you join us for that event coming up on May 4th, 1 o'clock Eastern. Let's start our Wrap the Week segment with a poll. We always have a poll running on our Stock Charts TV page. I'll also run them through social media and elsewhere. Recently, we asked, this is an interesting one, will the next 10% move in the S&P 500 be higher or lower? And out of all the responses, it was fairly close, but 56% of you said lower, only 44% of you said higher. Now, it's interesting, as the S&P is testing all-time highs, we're going to bring up a chart of the S&P here. When you look at the S&P making new all-time highs, 10% higher is another 420 points. That puts us at 4,600. 10% below here, is about 420 points below. That's about 3,700. So the question is, do we go to 3,700 or do we go way up here? And it's interesting that more than half of you said that it's more likely the next 10% move is lower, really retesting those lows from February and March. I did not vote in this poll. If I did, I would agree with the majority. I think that, given the overextended environment, given the fact that we've recently been overbought, given the fact that so many stocks are showing weakness that I think is not reflected in the chart of the S&P. I think, again, I maintain that the S&P is making things look better than they are. I wouldn't be surprised if we get a meaningful pullback down to 3,700. That's a 10% drop that will feel like an 80% drop, given how strong things have been. You see how things felt earlier this week when the market was down a little bit after being up so much. It doesn't feel good. And so if we have a steep pullback or an extended pullback down to 3,700, that would hurt. I think that would be quite a move for a lot of people to digest. But think about how much further, in my opinion, think about how much more constructive the market could set up to be if it has that sort of pullback to sort of make sense of all this recent overheatedness. You could not then claim that the market was overheated. You could not really claim it was overvalued, at least not to the extent that it is today. And it would alleviate a lot of these negative patterns that we've seen or signs of euphoria. That would certainly, take some of the euphoria out and potentially set us up for further upside. So very interesting poll. Thanks everyone for responding on that one. Let's continue on here with our wrap the week segments. What we usually start with is a chart of the S&P and other major asset classes. I'll walk you through what these different lines represent here very quickly, but this is showing the last Friday's close on April 16th to where we're at today, locking in the close and what changes we've seen. So essentially, and this is when I talk about the markets being in digestion mode this week. And again, I always, when I use that adjective, think of it as you've had a big meal and then you just need to chill. You need to relax and let your body digest what's happened. It's not about eating more. It's not about, eating less. It's just about, having a pause. And when you look at what the S&P has done, even though we had a nice rally today, even though we've had a lot of nice movements during the week, some down days and some up days, overall, the S&P net down 0.1%. That's essentially a zero for the week. So with all the movement, all the volatility, all the earnings, misses and wins, the S&P essentially went nowhere for the last week. This is truly a digestion week, a pause, and then setting the stage either for a rotation lower next week or a break to new closing highs, which we did not quite get today, as you can see, because that was last Friday there, and we're a little bit below there, but but pretty close on an intraday basis. So we did make an intraday high. It looked like just barely. So the S&P for the week down 0.1%. What outperformed the S&P? Gold, essentially flat for the week, 0.0%, rounding down a bit. Here's small caps and emerging markets, which were both around 0.5%, about 0.5%. The biggest gainer was the bond market, actually. The TLT was up about 0.6%. The S&P, again here, 0.1 to the negative. What underperformed the S&P to very, very close around negative 0.8%. That's the US dollar in green. And that's the NASDAQ 100 in pink. So, it's funny. I posted something yesterday about, or maybe this morning about the NASDAQ, not impressing. And just the fact that the relative strength has been deteriorating, even though it's doing okay. And I got a lot of pushback for that today because the NASDAQ does just fine, outperform the S&P. And I got a lot of heat for that sort of thing. But I stand by it. The juice has not been technology, but it's been other places. I don't think this week really changed that with a week of the NASDAQ underperforming the S&P. Here at the bottom is actually crude oil down 1.7%. Energy certainly has been, has struggled a bit. Some of those energy stocks that reported this week, like SLB and Halliburton and others, sort of right at that decision point. The question is, are they pulling back to an actionable level, an ascending 50-day moving average? We ride the next leg higher, or is this the beginning of further deterioration? I don't know what the answer is going to be. I think we have to wait and see for next week. By the way, if you're thinking about cryptocurrencies, this was Bitcoin down here, down 17% over the week. So here's everything we just looked at compressed here at the top. Here's Bitcoin. There's no doubt that Bitcoin has rotated in a lot of cryptocurrencies from huge uptrend mode with no top ever in sight. This thing's going to go shoot the lights out and continue on forever. Certainly seeing a give back in Bitcoin this week. And again, overall, this is the challenge with something like Bitcoin. It's been up so much, even with the pullback, it's still holding some pretty key levels, right? If you look at the chart of a Bitcoin, we'll start there for a moment before we continue on with some of the other charts of interest. Here's Bitcoin here. Today, we actually traded below the March lows, which is a really, really interesting level. 50,000 is sort of the key line in the sand. We talked about two of them recently. Once we pull back a little bit, the levels we keyed in on are the early April low, which is around 56,000, just below that. We actually broke that and continued down through the remainder of this week, through the second half of this week. We're now testing that 50,000 level. And I think 50,000 is a key one psychologically, but it's also key support on the chart. We traded below it, but closed back above it, which at this point is an indication of a pretty valid support level, right? Something we trade below, but buyers clearly coming in. And when you get below that level, push the price up to trade back above it. Holding 50,000, I would argue, would be really very, very important. If it breaks that, 42,000 is this shaded level here. That's the low from late February, also the high from early January. That's a really significant price level there. And that would be the next objective I would be looking at. The 200-day moving average, by the way, is all the way down here around 35,000. So you have to give back quite a bit to still remain above the 200-day moving average, which it hasn't touched for about a year, and still be within a long-term uptrend if that's your definition of it. But again, overall, I'd be looking over the weekend and into next week if 50,000 is able to hold and push Bitcoin back into a long-term uptrend. Let's continue on here looking at the Mindful Investor Live chart list. This is where we usually like to spend some of our time on Friday's show as we wrap the week. As a reminder, to get to this, if you've never done it before, go to the articles section of StockCharts. In the upper right where it says all StockCharts blog, go to my page, which is called The Mindful Investor, and there's a link at the top to a live chart list. That's going to be this one, and you'll get to this list of charts. You're welcome to save them to your login. Do whatever you like with them. They're yours to use. Let's start with the S&P market trend model. This is a weekly closing closing data that it's using to driven a model on 3 timeframes. The long-term model is based on the 21 and 34 week exponential moving averages. That has been positive since June of 2020, and nothing has happened to change that. It remains long-term secular uptrend. The medium-term model is more of the trading model. That more tells me when to lean into or away from stocks in general. That went negative from mid-February to late March, which is why you certainly heard my tone become a lot more cautionary, because that model tells me to start tapping the brakes and not be looking necessarily for new long ideas. That reverted back to a bullish signal at the end of March and is signaling through this Friday's close that we're continuing to be a thumbs up. The short-term model is simply looking at where we're at relative to the 5-week EMA. That's been positive for the last 8 weeks now. So overall, across the board, the model is positive. For me, that tells me to be comfortable looking for new ideas, to be riding longs, to be looking for good stocks breaking out, and in general, looking at the new 13-week high list and 13-week low list for opportunistic moves. And it's interesting, if you look at that 13-week high list, number one that I would notice is there've been a lot of stocks on there, a lot of stocks continue to make new 13-week highs, and they're clusters of names. And for example, this week, things like auto parts stores, what would I put in? AAP, Tractor Supply Company, TSCO. These are the types of stocks that have appeared on that list pretty consistently this week, worth paying attention to. Chart number 2, the daily chart of the S&P, and I spent some time earlier today kind of tinkering with the lines on here. I had some Fibonacci retracement lines that were really driven off of the February and March highs. The fact that we've broken above them sort of invalidates those as significant resistance levels, and we're more in a new uptrend. So I don't have any Fibonacci levels at this point because we're in a pretty good uptrend. You apply Fibonacci levels when the market starts pulling back, and the question is, okay, now that we're not going up anymore, where might we find support? And that's when you start throwing Fibonacci levels on here. Right now, when things are kind of long and strong, making new all-time highs every week, you don't necessarily need those on there. And I'll let you know when we need to start revisiting those. So what happened when I took the Fibonacci retracements off and just looked at the price of the S&P, I noticed some interesting things. Number one, if you draw trend lines from the October low, which was sort of the end of this base before we broke out and continued on for the next subsequent 6 months, the first major pullback, I would argue, where you could draw a trend line of support was taking the October low and the late December low. That lined up with the January low and the late January low. So a pretty valid trend line. We broke that in late January, bounced off the 50-day. So now we take a new trend line using that level from the end of January. That lines up with the low from the end of February. We then broke that one and broke down through the 50-day before reverting higher. Now I'm drawing a trend line from that subsequent low. And this idea where it's called a fan, where I keep taking the next low and drawing a new trend line. So what happens is you tend to not have more than 3 of those. Now that is a total like traders thing. I mean, that's not something, I don't think that has been rigorously back tested, but that's what I was taught early on, subjectively looking at trend lines, because more often than not, if you have to keep drawing trend lines, at some point the trend breaks and it no longer goes higher. And so I think that trend line taking the October low and now the March low might be a really important one. And what's interesting right now is it's right where the 50-day moving average is. So if and when we start selling off, which at some point I am certain we will do, it's not today, but at some point when we do it, I would be looking at that area. And that's around 4,039.50 to 4,000 at this point. That can change. Obviously, the longer it takes to get down there, the more that these lines will appreciate and that level will go higher. But I think, we remain above those things, the 50-day and this trend line, which is what we've been able to do through much of this uptrend. That tells you that the pace of this uptrend is fairly consistent. There's no reason to be too concerned about it. We don't have a ton of time left before the break, but I just want to jump really quickly and hit some of these other charts. Some of these we've reviewed randomly. The cumulative advanced decline lines all confirming new highs, except for in small caps where you have not had an upside confirmation. It'd be interesting to see today. This is not updated through Friday's close just yet. It'd be interesting to see if that finally confirms a new uptrend, but it has not. We've seen an expansion in new highs. That is what an uptrend looks like. That is not bearish activity. Almost 100% of the S&P are above their 200-day moving average. And that, for me, as always, makes me nervous. When that many stocks are in an uptrend, it tells me to be concerned for some reason. It tells me to put on the contrarian hat. Some stocks actually coming below their 50-day, which is what that green line at the bottom is rotating. But overall, that's still very constructive. Worth noting that the Ridex funds, we'll have to leave it here, but if you look at the Ridex funds, thinking about sentiment, we talked about this yesterday, that Ridex level is at the lowest level in history that I track on StockCharts. I basically inverted this so that it's more in line with other sentiment measures. If these bars are very very high, that shows you that it's bullish positioning. If it's very low, that's bearish positioning. So the fact that it's very high is sort of a euphoric reading, all-time euphoria, suggesting that individual investors are basically all in. They can't get any more bullishly positioned than they are right now. That doesn't, to me, seem like the beginning of a lot of further upside. That seems like more something I would see at the end of a bull market phase. We're going to take a quick break, and then we're back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Thanks so much for joining us every weekday on the Final Bar. I'm your host, Dave Keller, here at StockCharts. Great to have you join us, and especially appreciate you sending us your questions that we can answer on the Final Bar mailbag. We're going to open up the mailbag here in a second. But as a reminder, we'll do another segment with the mailbag next Tuesday, and we'd love to answer one of your questions on the air. Shoot us an email with anything that comes up in your own process, things that you see or hear or read elsewhere that you'd like for us to review or comment on. Just shoot us an email, thefinalbar@stockcharts.com. You can look us up on Twitter @FinalBarSCTV or on our YouTube channel. Just put a comment below the video that you're watching, and we would love to answer one of your questions in our next mailbag segment. Also, as a reminder, check out the StockCharts TV on demand. We released that earlier this year, and it's been very successful, in my opinion, because I'm super proud of the team and what they did to put it together and keep it updated with all of our great content. Our hosts, our guests, and all of their insights are all featured beautifully on any of the app stores that you might be following. Just search for StockCharts TV on demand, or just go to stockchartstv.com, use your email, set up a free account. You can start watching and saving content anytime. Let's open the Final Bar mailbag. So as I mentioned, you can send us your questions anytime. Here's some questions we've received in the last couple of days. Let's start here at the top. Many things going on in life. I appreciated your interview with your guest. The second chart was interesting. And how can we create that chart in StockCharts? Stay safe and have a great week ahead. I don't have the image, but this was who was this? This was Frank Capillari from Instinet, I want to say, was talking about the S&P. He had a great breadth chart looking at new highs and new lows. So basically what he did was he did kind of this sort of thing. I'm going to, probably a bad idea, but I'm going to try to create this chart on the fly. It's not going to look identical to it, but it's going to look pretty similar. So this is sort of a basic chart of the S&P 500. I think we did new highs, and let's say we could say like NYSE new highs, right? So here's the thing. What he basically did, what he did a moving average of the new highs, which is kind of a cool way to do it. I'm just going to use this index. There are a bunch of different indexes that we track. If you look at, a particular index or particular universe, you can get the actual ticker, but I'm going to do exclamation point new high S&P. So I'm going to add a price at the bottom. And I'm going to call it exclamation point new high SPX. Let's bring that up and make sure that that looks good. This is kind of what he did at the middle. And then he made the height a little different. So we'll make that 0.8, which is going to make it a little bigger. There we go. Now, the really cool thing that he did was this. First off, he made it a little less obvious. So we kind of lightened up the line like that. So it looks kind of like this grayish line. So here where you can make the opacity, I guess you'd pronounce it that way. There's probably a better way to pronounce that. So let me know if I'm mispronouncing that. Sorry, English teachers of past, but basically made this a little gray. Thank you, producer Denby. Opacity is correct. We've grayed this out a little bit. And then what you do is you add a moving average. And so that's what we're doing here. We'll see a simple moving average. We'll say 10. And then when you add the moving average, you basically have this as much easier to see. So the grayed out line is in the background. That's the raw data. And then we have a 10-day moving average, which is a little easier to see. And what he did was he looked at a little bit longer time. So he was looking at like a 5-year time frame, which allows you to bring in more data. And then the indicator itself is super, super noisy. I'm even going to make it lighter. And then the blue line is showing you the line you want. That's a 10-day moving average of it. So that's the trick that he did. You bring up a chart, add a series at the bottom using the indicator price, add the ticker that you want. And then what you do is change the opacity to something really low, add a moving average with like a 10-day moving average or something like that. And then the blue line is the one that's a lot less noisy and allows you to draw the analysis. That's what he was using to talk about some of the breadth readings that were a little more elevated. Great question, by the way, and thank you. And thanks, Frank Capillari, for showing us a good trick on StockCharts. Next question, is there a cheat sheet available for chart modifiers, things like underscore, the comma, and others? If not, maybe a punctuation section can be added to the glossary. So I'll show you some of the tricks, and these are just a couple ones that I've learned. And again, most of what I've learned on StockCharts, besides just experimenting on my own, is watching people like Greg Schnell and Tom Boley and Arthur Hill and Grayson Rose, who are power users, and know the product well, better than I probably ever will. I learned a lot from just watching their shows and asking them questions, and I learned a ton about just how to manipulate this platform. There are a lot of really cool hidden features. So I'll show you a couple quick things, and then I'll show you where on StockCharts you can find a full list of them. So things in general that you want to do. The ticker we have here, if you do underscore the ticker, that's going to be unadjusted data. So that basically takes all the dividends and splits out of the way. That's really good when you're looking at longer term support and resistance levels. You can also do a hyphen or a minus sign in the ticker. That will invert the scale. It's a quick way to just flip something over. You can see the scale's inverted. And that's a common trick we would use. If you think something is a good buy, flip it over and see if you think it's a good sell. And if not, that can help you understand maybe there's some challenges there. You can also do like just a minus sign. You could do some basic things. You could do IBM minus Disney, which I would tell you is probably a relatively meaningless thing to do. But if you think about something like interest rates, that's exactly how you would do like the 2 and 10 spread. So if we do this, you can say $UST 10Y minus $UST2Y, and you get the 10-year yield minus the 2-year yield. So if you're looking at something like yields or something, and you want to subtract just one versus the other, that's all you do. The first ticker, the minus sign, and the second ticker. So if you're unfamiliar with some of those, or if you want to see a complete list, here's what you need to do. There's a little magnifying glass in the upper right. Search for this article, which is called Data and Ticker Symbols. We have a full list. There's a bunch of stuff on here, by the way, a lot about the data, the sources of it, and all of that. But when you get down here a little while, you'll see things like all the stuff that you can add, the format of the different tickers, all the things that you can do to make some different calculations, adjust them, look at ratios, et cetera, et cetera. So that is the article question asker that I would direct you to, but I showed you some of the ones that I use the most often. Next question, how do you feel about market profile fitting in with the overall evaluation of stocks and indexes? That's actually a really good question. So as you can probably guess by the fact that I don't show it ever really, I'm very familiar with market profile. And my familiarity with it really started when I used to travel to Chicago in my Bloomberg days and meet with a lot of futures traders commodities traders, some on the floor of the exchanges in Chicago, but also upstairs in the Merck building and others where they were using market profile. And I'll never forget the first time I went to a shop where they looked at no bar charts or candle charts or anything. They simply looked at they simply looked at market profile charts and we're trading just the range. What that does is it basically takes a period of time and it turns the price movements into a distribution, and it looks at how much time we spend at different price levels. The book that I edited called Breakthroughs in Technical Analysis, one of my chapters is by Robin Mesh, who wrote an article particularly about using market profile on equity pairs, on stock pairs, and looking at the spread between two stocks and using the market profile. Pete Steidlmeyer, if you're not familiar with market profile, his work is really pioneering that discipline. That was one of the first books that I read on market profile, but Robin Mesh would be the other I would direct you to. So long story short, yes, if I was trading commodities, I would probably look at market profile all the time. I have at time looked at long-term market profiles, and I did some work early in my career really thinking about those long-term rotations. And again, Robin Mesh has done some really good job. If you look up some of her articles, you'll see what I mean there. That's it for the mailbag. There's some really good questions. Thank you all so much for writing those in. As always, just as a reminder, shoot us an email, thefinalbar@stockcharts.com. We would love to hear from you and answer one of your questions in our next mailbag segment, Tuesday of next week. Let's wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is India. I noticed earlier today, I was looking through a bunch of charts as I normally do in the course of the trading day. And I was looking a little more at some of the non-US ETFs, looking at some of the global equity ETFs, particularly China, which has sort of hit the moving average support, hit the 200-day on something like the FXI, which if you've not looked at that in a little while, you may want to check that out because potentially sort of a nice consolidation pattern right at the 200-day. Interesting to see if that resolves higher next week, or if it resolves lower and a break down through the 200-day would certainly be a negative sign for the long-term trajectory of a chart like China. The India chart is actually really interesting. When you think about what the S&P is doing, making new all-time highs, you can see why the chart of India, while it's not horrible, it's so much worse than the S&P. That's why the relative strength has gone from making a new relative high here in March to being pretty much in a 2-month, almost a 2-month downtrend in terms of relative strength. The charts of India, like many charts we've looked at in recent months, had that bearish divergence of higher highs in January and February and March. And look at how the RSI has been sloping downwards. So while some of those bearish divergences did not play out, notably on the S&P 500 itself, it did actually play out as you would expect in India. You've now broken down through the swing lows. You've broken down through the 50-day moving average. The 50-day is now sloping downwards. What concerns me here is you're nearing support around 39 on the INDA, which is where I would look. But I think you need to be looking at the 200-day moving average, if not the 38.2% retracement, which is all the way down at 35. That's another 5 points lower than where we're at right now. So India is a really interesting chart, really showing the value of bearish divergences, one to pay attention to them. Second, it's the 10-year yield. This is another one with a bearish divergence February into March, indicating an upside exhaustion in rates or a downside exhaustion in bond prices. The TLT has bounced up. The TNX, the 10-year yield, has come down. It's right to the ascending 50-day moving average. Now, again, all else being equal, if I'm just looking at this chart, I'm seeing something that has had a nice uptrend. It's pulled back to its 50-day moving average. The RSI is holding right above 40. That, to me, indicates an actionable time to expect the next leg higher. And that's what I would be looking at here. If it breaks the 50-day, and even more importantly, if it breaks just below 150, which would be the low from early March, and also this Fibonacci support line, I think that would tell me that rates are going to spend some time sort of in this range between 1% and 150, which I am not expecting. I'm expecting rates to go back higher, but that would be the indication. To break below 150, I think opens the way to much lower levels for an extended period of time. If rates are going to bottom out, I think we're right at the point from a technical perspective where it would make a lot of sense. Finally, this week has been all about the earnings, right? And all about different pairs of stocks, semiconductors, regional banks, technology stocks, FANG stocks like Netflix, and others. Next week is going to be more of the same. A lot of earnings coming out this week, including Apple. And I think this might be one of the key ones. Just like Netflix comes out, disappoints with their subscriber numbers, and all of a sudden the price is at the lower end of the range again. Apple has an opportunity to have a nice break higher. A catalyst driven by stronger earnings could certainly be doing. This is going to be a chart I'm going to be watching for sure all next week because that has implication for the broader market. That's a wrap for the show in the week here on the Final Bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. See you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.